Explanation of balance sheet and its components. Balance sheet can be divided into three major parts. 1. Asset. 2. Liabilities. 3. Shareholder equity. In broad term, asset is what your company owns. For example, cash in hand, receivables. Liabilities is what you, or your company, owe to someone, like debt, taxes to government. Shareholder equity is the difference between the two. I have pulled the annual balance sheet of IBM. Since I have taken annually, I am giving an example for 2020. This is just for explanation purpose, so that you can understand how to evaluate. I have not invested in IBM, and I am not promoting IBM. Asset can be divided into current and long-term. Current asset are things like cash on hand, or uncollected invoices, or receivables. Long-term assets like property, plants and equipment. You want company to have excess cash, so that it can be used in paying its debt, as well as acquiring the small companies, or if there are other opportunities. Here IBM is having $14 billion in hand. Receivable is the money that customers owe to the company, which customers have to give back to the company for various services. On one hand, you want the cash to be abundant with company. Also, please take a note that account receivables should not go beyond the sales of company. The sale is present in income statement, which we will discuss in next video. The rest of assets column have things like inventory, prepaid expenses, and other current assets. Always look for the total current asset, total long-term assets. Ultimately look for total assets. Liabilities can be divided into current liabilities and long-term liabilities. Current liabilities such as taxes which companies owes to government or short-term debt or account payables. Short-term debt is the debt which company have to pay, and accounts payable is the money which the company have to pay to creditors or suppliers. Long-term debt is the debt which company have to pay in future. Equity is the difference between the assets and liabilities. It consists of outstanding shares of stocks added to liabilities. Stockholders' equity causes balance sheet to balance. For example, in this balance sheet, we see that assets are $155,971 million. And the addition of liability that is $135,244. And shareholder equity that is $20,727 million is $155,971. Some points to remember. 1. Having debt is not good. But mostly all the companies have debt. We have to see that which company is having very small debt, or no debt. As Peter Lynch points out, a company can't go bankrupt if it doesn't owe any money to anyone. 2. Asset minus liability equals shareholder equity. 3. Shareholder equity should be increasing quarter by quarter. Obviously, if liabilities is reduced, the shareholder equity will increase in order to balance the assets. 4. Here I have taken the annual balance sheet to explain it in very simple manner. But in real, always try to look quarter-wise balance sheet. 5. Try to pick the company which is reducing the short and long-term liabilities continuously. If not reducing, then also not increasing continuously. 6. The cash on hand should be increasing quarter by quarter. As well, receivables should be decreasing. The end. Thanks for watching and please subscribe my channel.